Welcome back to the Lipstick Index, where we take the big, scary money ideas and make them tiny. Last time we talked about the stock market. Thousands of companies all split into tiny pieces, all available to buy and sell. And we said small, steady ownership, held through the ups and downs, has historically grown. But here's the question nobody answers clearly. How? How does an ordinary person actually do that? Do you need a broker? Do you need to pick stocks? Do you need to know which companies will do well? The answer is no. And the reason is something called an index fund. Here is what that means. An index is just a list, a curated list of companies used to measure how a market is doing. The most famous one is the S&P 500. It tracks the 500 largest publicly traded companies in the United States: Apple, Microsoft, Amazon, and hundreds of others, all in one list. When people say the market went up today, they usually mean the S&P 500 went up. An index fund is simply a fund that buys a small piece of every company on that list. Not some of them, all of them. When you invest in an S&P 500 index fund, you own a tiny slice of 500 companies at once. You are not betting on one bakery. You are buying a small piece of the entire bakery district. Now, here is why this changed everything. For most of investing history, if you wanted to grow your money in the stock market, you needed someone to manage it for you. A fund manager, a professional who picked stocks, tried to beat the market, and charged you for the privilege. The problem? Most of them didn't beat the market. Not consistently. Not over the long run. Study after study showed the same thing. Actively managed funds, on average, underperformed the index they were trying to beat, especially after fees. An index fund does not try to beat the market. It tries to mirror it. It buys everything on the list and holds it. No guessing, no picking, no expensive manager. And because it requires almost no active management, the fees are tiny, sometimes less than 0.1% per year. That difference in fees, compounded over decades, is enormous. A 1% annual fee on a long-term investment does not cost you 1% of your money. It can cost you 20% or 30% of your final outcome because of how compounding works. The index fund removes that drag. John Bogle, the founder of Vanguard, introduced the first index fund available to ordinary investors in 1976. Wall Street laughed. They called it Bogle's folly. Today, index funds hold trillions of dollars. Warren Buffett, one of the greatest stock pickers who ever lived, has often spoken highly of low-cost S&P 500 index funds as an option for many long-term investors. You do not need to be an expert. You do not need to watch prices every day. You do not need to pick winners. For many long-term investors, the appeal comes down to three things: time, low fees, and the discipline not to panic when markets fall. Because it will go down. Some years, a lot. The S&P 500 has dropped more than 30% in a single year. Historically, it has recovered from every major past decline, though no future outcome is guaranteed. That is the trade: short-term noise in exchange for long-term participation in the growth of the economy. The index fund did not make investing risk-free, but it made it simple and accessible and honest. For now, the key idea. An index fund lets you own a tiny piece of everything for almost nothing and hold it for as long as you want. That is the tool. Next time, we will talk about what happens when the economy does not grow, what a recession actually is, how you know you are in one, and why the indicators almost always lag behind how people actually feel. If this made one big idea feel a little smaller, give it a like and follow along. I will see you next time. Educational content, not financial advice.